If you're starting your investing journey, you've probably heard terms like index funds, mutual funds, ETFs, and hedge funds. They all sound similar, but they work very differently and are designed for different types of investors. Understanding these four investment vehicles is crucial because choosing the wrong one can cost you higher fees, lower returns, or unnecessary risk. In this guide, we'll break down each fund type in simple language, compare them side by side, and help you understand which one is best for you. Index funds. What is an index fund? An index fund is a type of investment fund designed to track a specific market index, such as S&P 500 NASDAQ, 100 Dow Jones Industrial Average. Instead of trying to beat the market, index funds aim to match the market's performance. How index funds work. If an index has 500 companies, like the S&P 500, the index fund invests in all 500 companies in the same proportion as the index. There is no active decision-making by a fund manager. Key features. Passive investing. Very low fees. Broad diversification. Long-term growth, focused pros. Extremely low expense ratios. Historically strong long-term returns. Minimal human error. Ideal for beginners and retirement income. No chance to beat the market. Market crashes affect returns. No flexibility during downturns. Best for long-term investors. Beginners. Retirement accounts. 401k. 401k. IRA. People inspired by Warren Buffett mutual funds. What is a mutual fund? A mutual fund pools money from many investors and is managed by a professional fund manager who actively selects stocks, bonds, or other assets. Unlike index funds, most mutual funds try to outperform the market. How mutual funds work. The fund manager researches companies, buys and sells assets, and adjusts the portfolio based on market conditions. Investors buy shares directly from the fund company. Key features. Actively managed higher fees. Bought and sold at end-of-day price, NAV. Pros. Professional management variety of strategies. Growth, income, balanced, good for hands-off investors. Cons. High expense ratios. Often underperform index funds. Tax inefficiency. No intraday trading. Best for investors who want professional management. People investing through retirement plans. Those comfortable with higher fees. ETFs. Exchange-traded funds. What is an ETF? An ETF is similar to an index fund, but trades on a stock exchange like a regular stock. ETFs can track indexes, sectors, commodities, bonds, cryptocurrencies. How ETFs work. You buy and sell ETFs during market hours at real-time prices. Many ETFs are passive, but some are actively managed. Key features. Trades like a stock, low fees, highly flexible, tax-efficient pros, low expense ratios, intraday trading, easy to buy and sell, more transparent holdings. Cons trading fees, if broker charges, temptation to overtrade. Not all ETFs are diversified. Best for modern investors, traders, and long-term investors. Portfolio diversification, passive income strategies. Hedge funds. What is a hedge fund? A hedge fund is a private investment fund for wealthy individuals and institutions. Hedge funds use aggressive strategies to generate high returns, regardless of market direction. How hedge funds work. Hedge funds may use leverage short selling, derivatives, arbitrage private deals. They are not regulated like mutual funds or ETFs. Key features. High risk, high reward, limited access, performance-based fees. Pros. Potential for very high returns. Advanced strategies can profit in rising or falling markets. Cons. Extremely high fees, 2% plus 20%. High risk, lack of transparency. Not available to normal investors. Best for accredited investors, institutions, ultra high net worth individuals. Hitch, one is best. For beginners, index funds or ETFs. For long-term wealth, index funds, tracking S&P 500. For flexibility, ETFs. For active strategies. Mutual funds, select carefully. For high-risk, high-reward hedge funds, only if very wealthy. What Warren Buffett recommends. Warren Buffett famously advises most people to invest in a low-cost S&P 500 index fund and hold it long-term. This advice alone has helped millions build wealth without complexity. Final thoughts. Index funds, mutual funds, ETFs, and hedge funds all serve different purposes. The key is matching the right investment vehicle to your goals, risk tolerance, and time horizon. For most people, index funds and ETFs are more than enough. Simplicity beats complexity. Lower fees mean higher long-term returns. If you want wealth, consistency and patience matter more than chasing hype.